Poul Kristensen, you run a number of MainStay's target date funds, which hold a number of different asset classes. So let's talk about a number of different asset classes going into 2016. And we'll start off with high yield because that's the one in the news right now having the biggest problems. Will it recover next year?
We think it will. Obviously, there's been some turbulence in that space recently. But as we see it, a lot of the problems that we see are actually concentrated in among issuers in the oil industry and in mining. That's where, by far, most of the defaults are occurring. And that's also where spreads have widened significantly. If you look at spreads in that segment of the market, they're now competing with the highs of 2008. If you look at the wider market, however, non-energy issuers, they're much more relaxed in a sense. Spreads are not as wide. So the spread between high-yield energy issuers and non-energy issuers is at its widest we've seen for decades. We think the problems are very concentrated in that area, and we think valuations are starting to look attractive from a long-term perspective.
And what about muni bonds in 2016? Munis were fairly solid when it comes to returns in 2015, except for Puerto Rico, which was a problem unto itself. What's your outlook for munis?
This is certainly an area where active management is important. There are some inefficiencies in the marketplace. Some of the dealers have very low inventories here. We think there are definitely opportunities here. Valuations are still fairly attractive from a long-term perspective.
All right, now let's switch over to stocks. Clearly, we're waiting for the Fed to hike rates. At least that's what everyone thinks they're going to do. So should people fight the Fed and stick with stocks in 2016?
I think what we're likely to see here is a Fed that's going to raise rates, but they're going to do it at a very, very gradual pace. And I think the message from Janet Yellen is going to be very focused on the caution, saying this is going to be a fairly gradual procedure. They're going to hike rates at probably a far slower pace than what they did in 2004, and certainly than what they did in '94. And experience tends to show historically that when we have these sort of gradual phases of Fed tightening, the stock market tends to do pretty well. If you look at valuation measures overall, it's clear price to earnings ratio is above its 15-year average, but it's also clear that bond yields are very low. So the alternative yield that you can get in the risk-free or the government bond market is so far lower. So anyone doing discounted cash flow analysis, you can easily make the point that the stock market is still fairly attractively valued from a longer-term perspective.
And do you need inflation in the system from commodities to help the stock market move forward? We've seen oil really fall off a cliff here. So what's your outlook for oil? Do you need oil to come back to help stocks move higher?
I think stabilization is important. Oil, of course, is a double-edged sword in many ways. The plunge we've seen in crude oil has created obviously a lot of problems in the oil industry, and some of the high-yield issuers in that space facing some trouble. There are some ripple effects of that. That's clearly a negative. But on the other hand, and that's a very important one, is that most of us, when we interact with the oil industry, it's when we fill up our cars, it's when we buy something that's been transported. These cost pressures have been reduced. So the loss of revenue in the oil industry is basically a major cost saving for everybody else. U.S. consumers are set to save something that's now coming close to $230 billion per year from this drop in gas prices. So consumers are doing pretty well. So the overall picture, yes, it's important that we get some kind of a stabilization in crude oil, but I don't think necessarily that a strong rebound in crude is a sort of a necessary condition for the stock market to do reasonably well, because the drop in crude oil does have some positive effects that will also play out over the next year or so.
All right, and then finally, what about U.S. stocks versus European stocks and emerging market stocks? How would you rank those three?
I would say European stocks, given the position that Europe is in relative to the U.S. in terms of where they are in the recovery phase. It's been a bumpy ride over there. There's been some political discussions about the monetary union, some uncertainties about that. And that means that they're sort of entered a recovery phase on a later note than we have. If you look at the most recent numbers, they continue to point to a region that's recovering. And given the fact that corporate earnings had been under much more pressure, and has only recently starting to recover, we think there's more upside in terms of earnings growth over the next couple of years. So we do like the European market. It's also benefiting from lower oil prices. Continental Europe is dominated by oil importers, and the weaker euro is also something that is enhancing the competitiveness Of course, on the emerging markets front, we have valuations that are looking very attractive if you look at it from a very, very long-term perspective. But we have to have a little bit of caution there with the Fed likely to raise rates. There could still be a bumpy ride in the near term, and there's also a lot of people pointing out that some of the reason why the price-to-earnings ratios in emerging markets are lower than they are here is the fact that some of the companies included in there are more or less state-owned enterprises in China, which probably where valuations, relatively low valuations, probably justified. So, but that said, from a longer-term perspective, emerging markets are starting to look very interesting.
All right. Well, thanks a lot, Paul.
Thanks for having me.
And thank you for watching The Street.